Right, good morning, Friday. Happy Friday. It's October 24th. Zach Howard, morning macro update. The end of the week, we had the U.S. government call back its BLS, Bureau of Labor Statistics staff, to put together some CPI numbers for the markets. Markets, particularly bond yields, currencies, trade off. But these Keynesian macro data points, I like them or love them. Take them for what they are. Fact or fiction, doesn't matter. This is how the markets are going to trade out these numbers. What do we get? Rate of change slowdown. So lack of inflation. We still have inflation. Don't confuse that with inflation went away. It just slowed from a rate of change standpoint, which we would call disinflation. For the month of September, 0.2% versus previously 0.3% in August, month over month. And a year over year number, headline, round number 3%, accelerating versus 2.9 previous. Disinflation on that core, which really matters, 3% versus 3.1% the previous month. On to how that affects markets, bond yields, looking at that US 10-year truth serum on risk, truth serum on price, price discovery for what that is. And what we've been seeing here over the last month is just confirmation in the data. Okay, the data shows up after the fact, which sees through to bond yields, sees through commodities, sees through precious metals, all been screaming that data set here of disinflation the last 30 days. When you look at gold, when you look at bond yields falling, US government bond yields, and you look at oil. Those three similar sets, which I did a video been talking about here for a few weeks, says disinflation. But this is the lowest level it's been now, going back really since the Liberation Day. We just broke those lows. Something to keep in mind how much lower that does. Usually gold correlates with a higher price in gold when the bond yields keep falling like this. Um, Interesting though, overnight we have the U.S. President in Chief Trump saying he is ending negotiations with Canada on the trade talks stemming from a Ronald Reagan ad from back in the day, how Reagan talked about how tariffs were bad or some BS. I don't know. But the big event is starting November 5th. The Supreme Court in the US will rule on those Trump tariffs that have been enacted and are a source of revenue for the US government. Okay? To keep financing these deficits, they need to have extra sources of revenue outside their existing. And they've been really putting some money away. If the Supreme Court rules that those tariffs are no longer, in fact, valid, there could be refunds coming from companies who've had those tariffs paid. But more importantly, the fiscal situation would worsen for the U.S. because that's revenue they collected. They would have had to otherwise now give back. And then going forward, we're talking about $4 trillion over 10 years in tariff collection, no longer there. That's a sizable deficit. I already showed you about the chart yesterday, how these governments are continuing to run deficits 7-8% fiscal of GDP outside of recession, outside of a wartime effort, no matter what. So you take these tariffs away, which the ruling probably comes down early January or early part of 2026. That could be a big market shock. I would expect bond yields to further sell off. The dollar here is working at DXY, further sell off, and then another bid into gold in that backdrop. More money printed needed. But as it relates to Canada, we're looking at the Canada 5-year bond yield, the one I watch, because as it relates to the mortgage market in Canada, it's now the lowest it's been since the Liberation Day April tariffs that came over the bow and really shocked everybody. 2.62% on that 5-year Canada bond. And he says Bank of Canada is going to have to get aggressive in the cuts as we slow down more aggressively. There is a backdrop of that. It's pretty all industry. Looking at the VIX, pull back, boom, from the week here. We were up around 20. Were we going to get an escalation? No, not at all. We pull back now. We're off to the races. 67.38 all-time lows in U.S. equity markets driven by those big mega caps: Nvidia, Microsoft, Apple, and Google, Meta, even car company, as I talked about yesterday. What did I say? Volatility falls. These mega cap, particularly the high beta ones like Tesla, car companies, they like that. They go higher in that backdrop. Same with Apple. but it had nothing to do with the earnings call with Elon opining about robots or any of that. It's really a product of the volatility. Silver's still bouncing around, oil still bouncing around, and gold still bouncing around. Nothing on the week. Bitcoin still in a bearish trend, kind of get over 112 here, see if they can do it, but it seems like still could be a potential pullback to 106 from the chart. And the catalyst for the S&P to break out those 7,000 S&P 500 hats is once we get through the next couple of weeks here, all those big mega caps, 69% of them are now in the blackout window. They are the non-discriminatory buyer of their own stock. They're going to get back on the bid and buy back their stock, which is a catalyst for all-time highs to continue despite these record levels. That's what I got from a macro standpoint today. We hope you have a great weekend and talk to you soon. If you like more macro content like this and you want to subscribe or you want to give me some feedback, this is what I really like doing. Please provide me in the comment section on what I can provide as value going forward. Have a great one.